Good afternoon, beautiful people. I'm Profound with Profound Thinkers Investing, the show. And we are here today discussing the deed in lieu and loan modifications. Our previous three shows discussed bankruptcy, chapter 7 versus chapter 13. Now we're looking at deed instruments and legal processes that take place when a person is facing either bankruptcy or foreclosure or both. So we're going to talk more with Dohn Thornton and explore his expertise in this area. So sit back, relax, and enjoy the show. Tonight, we have our reoccurring special guest, Dohn Thornton. He's a specialist in foreclosure prevention, alternatives to foreclosure, short sales. And tonight, we're looking at a topic that's very prevalent in today's society, deed in lieu and loan modifications. That's something that, as an investor, you will run into quite often when dealing with homeowners who are looking to find alternatives when they're faced with difficult situations. So tonight we're going to jump right in. Dohn, because we have had you on the show before, I know you've explained to people your history and your expertise, but will you just give them a brief synopsis of how you've come into this field and a little bit about your history?
Sure. I've been doing this for about almost 20 years now. I got into the mortgage business in 2002. That was kind of the springboard into my getting into real estate investing. After that, basically after learning all the ins and outs of how to be a mortgage originator and helping people get mortgages, and most importantly, learning how credit works, especially as for people trying to get, or finance the biggest purchase they're going to make in their lifetimes, I realized that there was a special niche in the business that at that time not a lot of people were really taking advantage of. And that was learning how to negotiate with mortgage companies for bad debt, about how to eliminate or reduce significantly bad debt when it came to mortgages on their homes. And so it took me about 9 months to almost 10 months before I got the hang of that. And then in 2003, I incorporated HB Funding, my company, and I've been doing that ever since. I mean, obviously, short sales are somewhat cyclical because they work best when we have a down economy and when the housing market is coming down, or is it stagnated, as it were. And but the nice thing about this is that because of my mortgage background, and I'm still licensed, by the way, so I still do mortgages occasionally. But I'm up to speed on everything. That's what's going on in the mortgage industry, and the reverse side of negotiating bad mortgages. I've learned a lot about how this works, and I've also unfortunately found out that there's a huge, I would say there's a huge delta, or there's a huge gap between what most people know and what actually is. And I'm just glad I had the opportunity to reach more people with this podcast, to let them know that there are a lot of things they may or may not believe about deed in lieu, loan modification, short sales, or anything that has to do with mortgages. They need to be informed, and I hope I can help inform people to learn more about what they can or should or shouldn't do.
Excellent, excellent. Yes, we are so happy to have you here, Dohn. So we're going to jump right into some questions I'm sure that can be helpful and add value to the lives of not only the people facing these circumstances, but the investors that are here to help them.
Deed in lieu basically is where a homeowner is agreeing to surrender his house in exchange for a promise from a lender in writing that they will not pursue the homeowner for any amount of money left over after the lender disposes of the property. Okay. So there's really no specific difference as far as a homeowner's credit rating or credit impact is concerned with a foreclosure auction or a deed in lieu. The fact of the matter is that in their credit report, it's going to show up as a foreclosure. So there's the only difference, like I said, is that the homeowner gets a phantom benefit that they say, well, we're not going to go after you for the difference. We're not going to sue you basically after it's done. The phantom part of it is that happens so rarely that they go after you that it's almost the risk or the danger to the homeowner from a credit point of view is almost negligible. Okay. I was involved in so many negotiations regarding deed in lieu and foreclosure and loan modifications, especially when we had the huge financial meltdown. And well, in real estate, it started in 2006. It didn't hit the country nationally until 2008. But that was 5 solid years of that, just doing that over and over and over again. And we were bringing in 20, 30, 40 clients a month. So our volume was immense. And I can tell you that from a point of view of a homeowner, the last thing I would do would be a deed in lieu of foreclosure because it gives you pretty much nothing. Okay. And, I'll give you just a little bit of it, just full disclosure. I did have a house go to foreclosure in 2006. I bought at the top of the market. It was, you think you're smart, but then you realize that sometimes you're not as smart as you think you are, and life tends to humble you a little bit. But I had resisted buying any property at all, and it was an emotional decision. Usually, you get in trouble when you make emotional decisions. But I had gotten divorced, and I wanted to buy a property in the same community as my wife and my son, and this one was basically maybe a 3-minute walk from them. And I thought I would go ahead and try to do that. And I did. And unfortunately, I bought at the worst time. I bought at the absolute peak. I mean, the market started going down a month after I bought the property.
Wow.
So I did an 80-20 loan, which is basically I did a first mortgage for 80% of the value, and I did 20% loan for the remaining half. So basically, it was 100% financing divided into 2 mortgages, and I bought it $423,000. When the market bottomed out, it bottomed out at 220. Okay.
Wow.
So as of last time I checked, if I had kept the property, I would still be upside down.
And that was what year?
This was I bought it in 2005, at the very end of 2005, first part 2006. So anyway, I made in the industry, they call this decision a strategic default. And I just decided that even though I could afford the property, I was not going to put good money into bad, or throw good money away on a property that I don't think I would ever get any equity for. So I decided just to bite the bullet and let it go to foreclosure. Now again, my timing was really bad because I tried to do a short sale, and of course I've been doing short sales. I knew how to do short sales. My problem was that because the short sale process, at least at that time, tended to take longer than it does now. But back then, you were doing a good job if you got it done in six months. The market started losing value, depreciating so quickly that by the time you got a negotiated amount set in stone with an agreement and a clear to close from the lender, values had already dropped, so that was upside down too. And so the buyers I had lined up would always walk away because they didn't want to buy a upside down property. And so what ended up happening was it basically went to foreclosure auction. Okay. And so my second mortgage started sending me letters saying, okay, you can, I mean, before I let it go to auction, I started getting letters from my second mortgage, which was really, the first mortgage was covered for the most part. But the second mortgage was the one that was taking the hit. And they were saying, listen, just do a deed in lieu, just deed back to us and we'll take it. And I never wanted to do that because I kept saying, what's in it for me? Well, we'll get you $3,000 for some cash. It's like, man, I'm gonna willingly take on a foreclosure like that just for $3,000. Oh, we promise not to go after you if it doesn't, if it goes to auction, we're gonna sue you. And I decided, you know what, sue me. That's fine. Just see what you can do. I didn't believe they would, and because my reasoning was the fact that I saw what was going around in the country, how just the sheer numbers of people that were losing their properties. I thought to myself, they're not going to go after everybody. So
Right.
I decided I was going to be a numbers game. So this is a long story, but I'm coming to the point now, is that the mortgage company was City Financial. They did collections on me for a number of months. And every time I got a letter from a collection agency, I did a cease and desist letter. And according to the Fair Credit Act of 2008, that means that they're done. They cannot legally contact you anymore. No phone calls, no letters, nothing. So, and then so I'd go 4, 5, 6, 7 months, and then a new company would show up because they bought the mortgage, the paper from the original from Citi, and they started doing that thing. So I would say cease and desist, cease and desist, cease and desist. Basically, for 5 years, I did that, and then finally, I got a letter from the company that bought the property and said, not the property, I'm sorry, bought the paper, the final one, and they said, we're releasing your liability, and they forgave the debt.
Wow.
Right. And so I learned, so this is just not just me reading in a book or reading newspaper articles. I mean, I lived it. Okay. And it really just reinforced what I already knew, is that there's a lot of bluster, there's a lot of rhetoric, but actually when you come down to it, there is you have a lot more resistance than, or ability to resist and to find a positive outcome for yourself than it was before. And so, but they also warned me, if you take this, that $70,000 is going to be considered income, and you got to pay the IRS that, because it's considered taxable income.
Mm-hmm.
So I went to my accountant and said, here's this letter. What do you think? He goes, he says, you're taking such a big tax hit. I mean, he's just taking such a big loss in that property. He says, all we're going to do is we're going to file this one particular form. I don't know the number of it. He says, you're financially insolvent for that year because your debt far outweighed any assets you had. So because of financial insolvency, the IRS will consider this a non-taxable event. That's what happened. So I got out of it, not owing anything and not getting bombarded with collection calls, and I didn't owe any taxes on it. So yeah, so I mean, my point is that a deed in lieu, it doesn't give you anything, and all it is, and it's considered. Trust me, as a mortgage originator, I can tell you that as far as you going to a bank or a mortgage company to try to get a loan, especially a government loan, which is VA, USDA, or the United States Department of Agriculture, or a FHA loan, you're waiting 7 years to even try. And deed in lieu is no difference from that point of view as a foreclosure auction. Okay. So it's a long story, but just to illustrate my point is that deed in lieus offer you real, I would say, negligible value.
Right. Today on Wisdom's Corner, we're going to look at what we explored on the show today. So we discussed what a deed in lieu is, also what a loan modification is. We looked at, should a homeowner do a deed in lieu? We also considered using logic as well as emotion in decision making. We talked about what a strategic default is. We also discussed why timing the market is important in a real estate investment transaction. We also learned what cease and desist letters are. We further explored the Fair Credit Act of 2008 and what it entitles homeowners to. We looked at the importance of consulting with an accountant in real estate transactions. And lastly, we looked at how a deed in lieu affects our ability to get future government loans. So these are the topics that we explored in today's show. And as we end on our Wisdom Corner, let us remember that information applied is the power. We can have as much information as we want, but if we don't apply the information, then the power is not going to be behind the information. So let us continue to watch, share, like the post so that we can spread this information to the people who need it the most. And we thank you for joining us again today on Profound Thinkers Investing, the show. Have a great day.